want to thank you all for joining us today for our June business seminar. We got a wonderful presentation being presented to you by our associate, Scott Fisher. I just want to let you all know that there will be time at the end of the seminar today for questions. So please wait until that time. At that time, you'll be able to use either the question and answer section, raise your hand, or type it into the chat to let us know you have a question. We do these every month, so please come back if you aren't coming regularly already, and bring anyone you know that might find value in any of the presentation subjects that you see. With that, I want to thank you all for joining us and hand it over to Scott. Scott?
Thanks, Chris. So I am Scott Fisher, one of our financial advisors here on our team at John Graham and Associates. And so today what we're going to be talking about is some benefits there with 401ks and retirement plans, and really, who benefits by having these retirement plans, why should you have one for your business, and then really those features or that some of that plan design that goes into those benefits. So, as we kind of go through this, what we're really focusing on is how can we reward and retain key employees and maximize that benefit for the business owners. So first, coming in is really, who benefits by having retirement plans? And step number one is, really the employer, the business owner can also benefit from that. And so with that, there's a lot of different types of retirement accounts, and what we're focusing on here is more of the 401k style of plans. And step number one is, 401ks offer more contribution limits than what a simple IRA can provide. There's a lot more customization within the plan features between the different types of contributions that are able to come in, and some of these features are really going to be beneficial to businesses with strong profit margins, reliable earnings of income streams. If that's one of your businesses is what we're describing, we're going to have some good ideas to that we're going to go through here. So the other big benefit of who benefits in addition with the business is through a larger tax deduction. And so how does having those higher expenses there through the 401k, through contributions and other features, also benefit the business owner and the business there through taxes as well. So why have a retirement plan? And so really first, for majority of business owners, a lot of their net wealth is built into their business. And so through that, owning of the business can for a lot of times be not liquid. You can have a high net worth, but not be able to have access to that wealth. Kind of a great example of this is farmers, right? Where they might own a lot of land and have that high net worth because of the land value. However, they can't just go out and spend it without having to sell any of the dirt. So with, the main benefit is being able to create liquid assets and have a little bit more of a liquid net worth by utilizing things like a 401k and other types of retirement accounts. So also through these retirement accounts, you're going to have the ability for the owners to really take advantage and maximize the benefit to them and to any other key employees that would make sense. And so through that, not only is all of the employees are still able to participate. It's still a great benefit for them as well. But really, those key employees and the business owner can have even a little bit more benefit if they would like. And so through that, it can really be a game changer, and that not one retirement plan is really just built the same. You can get very customized and make sure that your business is maximizing those benefits, for all the employees and for the business owner there as well. So let's talk about a couple of different features here through the retirement plans. What the only way to contribute to these plans is, hey, they're allowed to defer from their salary through payroll. That's from the employee's side. Now, with the business owner and the employer side, they have the ability to make matching contributions with a dollar for dollar match, or some type of variation of a matching program, as well as profit sharing and cash balance features there as well. So through this, now not all of the employer's contributions have to be equal amounts. Depending on the compliance testing, you are able to maximize those benefits for either owners, key employees, the higher salaried employees there as well. And so by utilizing the new comparability rules, they're in a profit sharing plan, a cash balance plan, or a deferred comp plan. You're really able to get pretty creative on the benefits that you're able to provide, all while still being compliant with the rules and the regulations as well. So let's dive into a little bit more of 3 different types of those plans that I just spoke about there last slide. So first is that new comparability profit sharing plan. So with that, the employer has discretionary matching or discretionary, contributions in there that can be easily modified by year to year. Another feature of that is now the employer can treat each employee either equally through that profit sharing or, hey, separately, and have different percentages of profit sharing for those employees. So now that is dependent on everyone's situation, going to be, just depends on some compliance testing that's involved with that. Secondly is a 401k plan with a cash balance plan there attached to it as well. And so one of those main differences is going to be this style of plan is going to have some fixed expenses on the employer side, where they're going to have mandatory funding each year on the employer side of things. Now, looking at the deferred comp plans, so this is much more popular for those C-type corporations. And so with that is it's the employer's promise to pay those benefits there in the future, that instead of paying that full amount here today, that we're going to defer your compensation to a later date and pay you there in the future. Obviously, why would a company want to do that? One, helps them, helps them retain and attract those key employees with higher potential salaries without having to cash flow that here as of today, as well as could help the employee keep their income lower potentially, and defer that income, but it is still promised to them at a later date. So it can help them with their tax situation as well, and really allows them to to show from the business owner and the employer side that, hey, we very much care about you as a person. We want you to continue being on our team, and help them in through these situations with the deferred comp. So now this is not so much of a formally funded plan where that promise to pay in the future. You can technically kick the can down the road a bit, but what is pretty often with companies that have deferred comp plans is they do set aside those assets, the same year that they would have been paid into a general account. What that allows them to do is, one, have that money already be put aside. So in, 5, 10, 15 years, when that deferred comp is, being promised, those funds are already there. Just a little bit better way of bookkeeping and handling your business cash flow, and making sure your liabilities are going to be met there in the future. Now, with that general account, as soon as the business owner puts those funds in there, there is no tax benefit as of today. All of those future benefits to the employee, to the employer, are all going to be there at the future date when that compensation is paid out there in the future. So now let's jump into a case study here that kind of really, what we're going to be able to do is to compare 4 different types of retirement plans and the pros and the cons of each, and how can the business owner and key employees maximize what they're saving for retirement, how can the business maximize their tax deductions through these retirement plans, and kind of just in 4 different scenarios. So what we have here is we're going to be looking at a doctor's office where there are 2 owners and 2 primary physicians that own the business. The majority owner is their spouse is working, as well as about 7 additional employees. So as we go through these next couple of slides, there's going to be a lot of information, census information there, date of birth, all these things. I'm going to point out to you here some of those key things that you want to make sure that you're looking at. And so as we go through this, the census info, we can see the 2 main owners are the 2 main doctors. To the left here, what we are able to show are the principals, the owners, and then the highly compensated employees. And so through that, what we're going to be focusing on is, through all these examples, are those principal or those key employees. And so between that is the 2 doctors, the doctor's spouse, and then a nurse practitioner as well. That's in the office. So looking at how can we maximize the benefit for the principal owners there in the retirement accounts versus just the general employee or a non-principal. So a couple of those things that I'll also point out here is the age of these employees, where you can see the one doctor and their spouse are both over the age of 50. We'll see that kind of come in with some catch-up rules here later in the next few slides. Now, first plan that we'll be looking at here is a simple IRA. Now, a simple IRA is very popular with a business just starting out because it is very straightforward, very easy to understand from the owner's point of view as well as the employee's point of view. And so what we can kind of walk through there is, here in the middle, we can see, focusing on those principal owners, we see their earnings, their age. Looks like those three are looking to maximize what they're putting into, the retirement account. And so to maximize it is 13.5. And then with the simple IRA, you're going to have up to a 3% match there on the employer expenses. So with that, you're able to put as the match, have 3% of the earnings of the employee. Nope. Sorry there. And so with that, bring that all up, and then the doctor and the doctor's spouse are able to put in that extra $3,000 for the catch-up rules, brings into the total of, here for the main owner, a little over $25,000 in savings. So now on top of, not to just focus on the owners here, but the rest of the employees are still getting a benefit here as well, where, they're able to take advantage and, be in control of their own savings for retirement. If they want, they have the ability to participate here in the simple IRA. And then they also benefit there from the match as well. So you can see this office employee here on the second row, well, they only put in 2%. So they're only going to get a match of up to 2%, versus now the office manager who put in 5%, they're going to be receiving that full match of 3% of their salary. So in total, kind of to be able to really show and compare these 4 different plan types, what I'm going to be pointing out here is 2 things. These total contribution side here, where we're going to see the total amount saved under each different plan, and then the employer cost is how much is this going to cost the employer, which can turn right around and say, well, hey, how much are we lowering our income? How much are we saving on taxes by being able to have this as an expense? So that total contribution here for the simple IRA for the whole plan is going to be about $92,000. The total cost for the employers is going to be $57,550. So as we can see here, those key employees or the principal owners are taking up over $52,000 of that $57,000. So obviously over almost 92% or 91.5% is going towards those 4 people. Now, to compare it to a 401k with the safe harbor match plan. Now, with the normal 401k does come with some compliance testing through that. Now, having it be a safe harbor match plan that does get you around some of the compliance testing. So walking through here, one of the main differences between that 401k and the simple IRA, what I stated earlier, was the higher contribution limits. So right off the bat, you can see looking at the first 4 rows really here, the doctors and the business owners, they're going to be able to put it 19.5 or versus, hey, with the much lower simple IRA max there. So through the safe harbor, they're gonna still continue to have a match. Here's the example here at 4%. So higher than the 3% max that you can do with a simple IRA. So again, we see that catch-up rule coming in here when you're above the age of 50, totaling for the majority owner of a little over 37,000. We kind of look back into that simple IRA, it was much lower. So as we look at everything as a whole, the total contributions or total amount saved, over 125,000. The employer cost is going to be 81,650. So as we continue, with looking at this plan, comparing it to this simple IRA, much more savings. Yes, some higher employer cost, but really where that's coming through, as you can kind of see here on these higher sides, is more just the salary. It's being the owner, you're going to have that's technically an employer cost, as well as some of that higher matching as well. So yes, a little bit higher cost, but also significant more benefit. So now we're looking at a 401k safe harbor, but with also with a profit sharing side of it there as well. Sorry there, just running some technical difficulties. All right. So with that, now looking at, hey, how that same safe harbor, but there with some profit sharing there as well. So coming back to it, we can still see that same amount of the maximizing that 19.5. We're going to have a 3% safe harbor contribution. And then what we can see here is the profit sharing that doesn't have to be equal towards everyone. As you can see here, the nurse practitioner is receiving 10% of the profit sharing, and then versus, hey, some of the office managers is only at 1.39. So what that allows you to do is really maximize that savings for your, as the owner, as to help those key employees. What we see here is the total amount being saved just under 195,000, with those employer costs of 150,000. So absolutely, with part of that profit sharing, we do have to, we can't just exclude any of these other employees. And so they also are receiving that benefit of having some more, profit sharing coming into their account, and, having their retirement savings grow. But also, where you can really see that benefit is with the business owner, with those key employees, really maximizing their contributions. Now, lastly, what we're going to be looking at is, hey, if we added another cash balance portion to that, safe harbor 401k with the profit sharing. So this is really allows that majority owner to receive that maximum benefit. So what we really see here is that that cash balance amount being sent at 215,000 there for that majority owner. They're able to still contribute to that 401k balance of 26,000. That's that 19.5 plus the catch up, with their safe harbor match plus that profit sharing there, where what we're really able to see is, the amount of savings there between both of the owners and the key employee, is a significant amount. So lastly, speaking a little bit about taxes, and here's just some summary and hypothetical analysis is, going through that here, what you have is the total employer contributions of the 332,908. Estimated tax savings because of that, 113,189. So that net cost after those savings is just under 220,000, bringing us down to the net cost of the plan after those principal contributions and tax savings, where you've saved just over 91,000, while you're still able to max out the business owner's benefit, providing that more liquidable net wealth, as well as those benefits that we spoke about there before. So in summary, going through those same things that we have, not every benefits package and retirement plans are built the same. There's a lot of customization between the features that can really, depending on the business owner's goal, can really not only maximize what they're doing with their retirement, but also, very much help all their employees. And he can be using that they can be using that as a retention tool for those key employees, to keep them, and also as a recruiting tool while looking into this competitive market employment place that we're at right now in the economy, to make sure that you're attracting the best people as well. So through that there, the next steps, if we do have any questions, we'll open that here as well. But reach out either to myself, again, Scott Fisher, with John Graham and Associates, or one of our other partners, Chris Franklin, there as well, to be able to walk you through and have that conversation about what makes the most sense for you and your business. So with that, Chris, I'll kind of just see if we have any questions.
I just want to thank everybody for coming out today. And I really think the important thing here, the biggest thing I took away, is how there are options to help you be competitive in today's workforce by providing additional benefits for key employees. So we thank you all for coming out. We hope you found this of value. Again, we do this every month, so please come back, bring your friends, family, and anyone you feel that would derive some value from any of the subjects that we are presenting on. And if there is a subject that we don't have on the schedule that you'd like to see, please let us know as well. We'd love to get your feedback. So thank you very much, and hope you all have a wonderful afternoon.